Happy 222222 day. We'll actually have a little bit more to say about that in tonight's video, but despite the uniqueness of today's date, it wasn't a very unique result in terms of Wall Street performance. We had yet another 1% down day. Most of it, of course, on the backs of the Russia-Ukraine situation. We did have some unique circumstances I wanted to talk about in tonight's video, including how oil itself was up, but oil stocks were down. And then I also wanted to show you from a calendar year perspective just how bad our results would be in 2022 compared to all of the other calendar years of the last 20 years. And then at the end of tonight's video, I want to get into the trade application example where I wanted to focus on a dividend stock that got absolutely hammered today despite raising their dividend 15%. And I thought maybe it'd be an opportunity to take advantage of it with a sold put opportunity. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's 2-2-2-2-2, and we'll actually have a little bit more to say on that a little bit later in the presentation. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list. Additionally, we're heavy users of Twitter. My handle is @BrandonVanZ, and I would encourage you to click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence over on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity, and let's take a look at our heat map here from the S&P 500. As you can tell, it was another sell-off type of a day. No surprise considering the more ugly conditions we've been dealing with here for the better part of the last couple of months. But in particular, this last weekend was a bit of a struggle, and people were wondering where things would shake out by the time we got into trading here today as a result of what's happening with Russia and Ukraine. Last night, before I went to bed, some of you that were following me there on Twitter might have seen me tweeting about the U.S. futures markets and also the Russian stock markets and how some of those numbers were looking quite ugly before I went to bed last night. And so I didn't know what to make of the fact that when I woke up this morning, we were back to break even on the S&P 500 or thereabout. And so we had quite the recovery overnight. And as we kind of started this session off today, we started off a little bit lower than break even, but things didn't really get too out of control the way that the fears were earlier in the weekend, when the fear was that the sell-off was going to kind of get to more of a capitulation type of a stage, or a washout event, or a rug pull, however you want to state that. So while today's heat map here does look somewhat ugly because there's way more red than green, as you can see, the percentage of the moves themselves across the index were not nearly as devastating as what was originally feared. So I guess we have that to be thankful for, as the S&P 500 closed lower by just over 1% here today. Nonetheless, there were some big movers, as there typically is during earnings season. One of them that stands out like a sore thumb is the one right in the middle of us right there, HD, that's Home Depot. That was the worst performer within the S&P 500 today. And I'll actually have more to say about that later in the session, but after reporting its earnings, it was down by nearly 9% by the time it was all said and done. It did close well off of its lows, but still a pretty tough day for Home Depot shareholders there. We also saw quite a big sell-off there in Netflix. It was down over 3% here today. Boeing was also down pretty significantly today, nearly 5%. For those of you that have a Netflix subscription, maybe you saw the Boeing documentary over the weekend, as I did. I can't remember how long it was, but I did happen to check that out. So if you're interested in business documentaries, there's a pretty good one on Boeing that just hit Netflix over the weekend, but it did not put them in a positive light, let's put it that way. And so perhaps that played a role in Boeing's nearly 5% sell-off here today. John Deere also struggled. It was down over 4% here today, as were a number of other companies kind of in that general vicinity. One interesting element of the market here today is how poorly oil stocks did. Notice that within the oil patch here, we had nearly a clean sweep of negative performers for oil stocks. I guess technically you could say that Hess was break even here, so maybe not a full clean sweep to the bearish side of the equation, but nearly. And all by itself, that's not necessarily the most uncommon thing. Remember that many oil companies are highly correlated to one another. So when oil prices are up, usually almost all the oil stocks are up. When oil prices are down, nearly all the oil stocks are down. Well, today what made it peculiar is that energy prices actually rallied. A lot of commodities rallied in the wake of the Russia-Ukraine news, yet oil stocks themselves suffered. So that kind of gives you the impression that perhaps some of these oil stocks that had rallied, 20, 30, 40% on a year-to-date basis maybe got a little bit ahead of their skis here so far this year. So that was a little bit of a surprise with today's trading. We did find that in terms of any more, clustered up, kind of green blocks, you could maybe get away with saying that, hey, we had some green clustered up here in the real estate space, and then also here in the healthcare space. It seemed like healthcare held up a little bit better than the typical securities here today. But otherwise, again, is one of those days where it was pretty overwhelming, where the bears truly controlled today's price action, even if it wasn't as violent as had been originally feared. There's way more red on this chart than green. Let's come on over here to the main part of the Thinkorswim platform and kind of get a sense from a visualized perspective here. If we pop over to Index Watch and then pull up the S&P 500, give me a second here to get this pulled up. You can see what the breakdown was today within the S&P 500. You had about 116 stocks that managed to close in the green, and we had about 384 stocks that closed in the red. So not nearly as devastating as a few of those days that we saw here last week and the week before, where, in some of those cases we had, basically, 80 to 85% of the stocks closing lower. Today wasn't nearly as bad. Part of that, as mentioned before, could have been because those healthcare companies seem to hold up pretty well here today. All right, let's also take a look at this chart. I like to bring this up whenever we have at least a 1% move in either direction. Today we just barely crossed that threshold. S&P 500 was down 1.01%, so about as close to a 1% move as you could possibly get. And you can see how that looks on this chart 6D. Remember, if you're a premium member of Market Scholars, you get access to not only chart 6D, but the 50 plus other customized charts you see David and I using in our presentations and trading rooms. But anyway, on this particular chart, we have this kind of zero line listed in black here that goes all the way across the middle. Then you've got some green bars up atop, and then you've got some red bars down below. And when the bars are green, those are days, in this case, when we're using a daily candle chart, where the S&P 500 is up, and the size of the bars tells you how big of an up day it was. So for instance, back here on January 28th, that was a very healthy green bar that got up and over this orange line that says 2 next to it, meaning that we had more than a 2% up day on that particular day. On the flip side, these red bars that go down low are showing us the sell-off days. And it gives you a general sense as to what the attitude of the market is at any particular moment in time. This isn't the first time I'm bringing this up, so forgive me if I sound like a broken record. But for those of you that are watching for the first time, one thing we've been identifying is how wild the trading has been in the last couple of months compared to most other parts of 2021. This was relatively quiet trading back here. This is more aggressive trading over here. It almost looks like a Richter scale, like when you're looking at an earthquake, right? The bigger the movement, the more volatile it is, both up and down. And that is what we are experiencing at this moment in time. This isn't nearly as bad as what we experienced back in 2020. To get a sense of that, I could change the chart time frame here just to show you 2 years ago, still staying with the daily aggregation period, how aggressive this was way over here. 2 years ago, remember, we're almost ready to pass the 2-year anniversary of the worst part of the coronavirus. This was the time of year when, 2 years ago, we knew that the coronavirus was a bad situation, but we hadn't yet shut down like the March Madness tournament or things like that. That happened a little bit later. So we're about ready to kind of anniversary, at least the 2-year anniversary of those bigger events there. But you can see back here, we were seeing just massive, massive movements. I mean, some of these days were, it's hard to remember back then, but we're literally talking about a day right here that I'm pointing at where the S&P 500 was down 12% in a single day. And you can see over here some of the up moves. We were, up, in some cases like 8 or 9 or 10% in some of those days as well. So, what we are experiencing right now is an afterthought compared to what we experienced 2 years ago. But again, if we go back on just a 1-year chart here, you can see that it's been more aggressive than what we saw, let's say, last summer and last fall. So, once again, a 1% down day here as it takes this red line down to this blue horizontal line where that represents the 1% sell-off area. We've had a lot of those, right? So far since the beginning of this year, right? If we wanted to change this time frame, instead of a 1 year, we can do a year-to-date chart and just show since the beginning of this year how this has looked. That's kind of interesting there as well. It gives you a different perspective. First of all, note how many days have these red bars. We have way more red bars than green bars, telling us the bears are a bit more in control of this market than the bulls have been. And when we've had those sell-off days, they've largely been pretty aggressive. It almost seems like most of these red bars down below here have crossed that blue line, telling us that most of the days that the market sells off, we've had at least a 1% sell-off day. So not only have we had more of those days, but they've been more violent as well. Now, speaking of this and changing some of these time periods. Some of you saw me tweeting about this. I think it probably would have been Friday. But I found this to be interesting. Check this out. If I check or if I change the time frame to a 20-year and change the aggregation period to a full year, so I'm going to have 20 bars here. Each one of those bars will represent one kind of calendar year as an aggregation period. Check this out. So in the last 20 years, this would be considered, where we're at right now in 2022, this would be considered the second worst year investors have had in 20 years. Now, I found that remarkable because I just definitely wasn't thinking of that in my own head. There's been obviously more difficult periods that we've had along the way, but those periods have oftentimes been reversed. So as an example, in 2020, if we were to be looking at this bar on an intra-year basis, if we'd looked at it in the middle of March, it would have been down 35%. But 2020 was a very peculiar year where not only did we regain all of that 35% that we lost, but then we added on top of that, and we actually ended the year up basically 16%. So again, I know we're kind of in an alternate universe, so to speak, when we talk in these terms, because it's only February and this year is not done. But, if the year were ending right now, this would actually be the second worst year behind 2008 that the S&P 500 has had in the last 2 decades. And that accounts for the vast majority of my own trading career. I've been trading for about 22 or 23 years myself. So the last 20 years is a big chunk of my entire history of trading myself. And in my own head, I wasn't thinking in those terms. So that was a little bit surprising to me and perhaps a bit surprising to some of you as well. It is a reminder as well, over the last 20 years, we haven't had very many down years. This one was a flat year. You can just barely see it here because everything gets skewed as a result of 2008. But technically, this was a slightly down year. In fact, if you look at this number right where I'm circling there, and then I go back and point at that, you can see that it says it says minus 0.0031. So in other words, on a price basis, it was just barely down that year. If you were to add back in the dividends that were paid, technically that would have been an up year on a total return basis. But then there's this other year right here, and so by the way, that was 2011. This other year right here, 2015, you were down 0.72%. In other words, not even 1% there either. So those two you could basically say were just break-even years. They weren't technically down years. This was a down year in 2018, and this was a down year in 2008. That was it before this year. I mean, it's kind of insane to think about because we've been really, really blessed as investors if you think about it from this perspective. If you go back throughout history, you do not see 20-year periods that look like this very often. And it's a little bit nerve-wracking in a way because we probably have received more than we've deserved as investors in the last 2 decades, and we really haven't had to put up with a whole lot. And so it could mean that the coming 20 years are much worse than the previous 20 years. It doesn't have to mean that it results in negative returns. Remember that the longer you're willing to hold a portfolio of stocks, the greater the chances you're going to have positive returns. But if you're setting your expectations about the coming 20 years based upon the last 20 years, unfortunately, you're going to be probably sorely disappointed. We've been very, very blessed here. So I found that to be fascinating. Thought I would share that with you as well, that technically, if we were to close down the year right now, this would be the second worst year in 20 years for the S&P 500. All right, let's go ahead and take a look at some other charts here. Let's do our 4-grid chart, chart 4B. And as you can see, the charts still look ugly. I used those words on Thursday when I was with you. I'm still going to use the words right now. These charts look terrible. They look ugly. In fact, speaking of the word ugly, I had to use Google Translate to see what ugly translated to in Russian for a post that I posted to Twitter last night. Some of you saw that. But anyway, I think that it's not just the Russian markets that look ugly, it is the US markets that also look ugly. Doesn't mean that it can't change, right? That's why we look at this stuff day after day. Things do change, new information hits the markets, not only from a geopolitical perspective, but also because we're in the heart of earnings season. So things can and will change. But as of this exact moment in time, here in the present, these charts look terrible, at least if you want to be bullish the stock market. All of them have strongly bearish intermediate postures. Notice that dark red background color on all 4 of our charts right now. In addition to that, all 4 of these charts have red moving averages, telling us that price is below a falling moving average. Remember a couple of weeks ago where we briefly went to a bullish posture, and I said I don't personally trust that bullish posture. And the reason I didn't trust it is because we weren't trading above the moving averages. Had we stayed above the moving averages, then slowly but surely, you can drag me, kicking and screaming to the next posture. But until I see actual constructive activity on the charts, I'm a little hesitant to say that, hey, everything's good to go now. Because while there's interesting opportunities out there for long-term investors, most of you that listen to this particular video are short-term traders. And in this particular environment we find ourselves in right now, I would suggest that we are still way more bearish than bullish. And I will reiterate a phrase that I had mentioned to you a couple of weeks back, which is this is a market where you are selling the rips, right? For the longest time in 2021, it was the battle cry was buy the dips. That's not where we're at now. This is now a sell the rips market. If you're lucky enough to catch a bounce back to the upside, you should be thinking reload the bearish gun. You shouldn't be thinking, okay, the coast is clear, now we're off to the upside, right? Eventually there will be that moment, but we're just not there at this moment in time. We've got work to do. In fact, I would say that things are looking even worse than they had been previously. And the reason that I say that is you'll notice that from a closing price basis, we are at new lows, right? At least for the S&P 500, for the Dow Jones Industrial Average, and I think for the NASDAQ. Oh, I take that back. The NASDAQ technically had a slightly lower low there on January 27th. Russell 2000 is well above its lows. Again, I shared those thoughts with you a couple weeks back as well, saying that the Russell 2000, for as bad as the chart looks, has actually held up reasonably well on a relative basis during this period from late January to mid-February. So their chart looks a little bit different there than some of these other areas. But it is concerning that if you were to look at the S&P 500, which remember is basically the world's benchmark from a stock perspective, at least the most important one, right? Because of the liquidity and the market cap that is controlled in the United States and of America. It's not to say that other countries aren't important. They most certainly are. But if you were to say there is one and only one index that market professionals stare at and try to beat year in and year out, is the S&P 500. And so you can see here that the S&P 500 closed at 4304. And while we did go below that on this candle back here on January 24th, we didn't close down there. In fact, that day, that was the day where I was sharing with you my colorful language of flush the toilet moment, where you tripped up a bunch of stop losses and then you actually closed higher on the day. We did sell off the next 3 days after that, but they weren't violent sell-offs. The worst close that we had was right here on January 27th, and that day we closed at 43.26. In other words, 22 points higher than where we closed today. In other words, we are 22 points lower today on the close. This is the worst close on the S&P 500 going back quite some time. These are 3-month charts here that we look at by default, but let's go back on a 6-month chart. And this is technically the lowest close for the S&P 500 since going back here to October 4th, what I call National Truck Drivers Day. 10-4 Big Daddy. A little bit of fun there with the with the numerals within the date back on 10-4, just the way that we have a little bit of fun today with 2-2-2-2. But anyway, with this particular candle back here on 10-4, that close was 4,300. So we were only 4 points away from being at 6-month closing lows today. In other words, it could happen tomorrow, right? It'd be easy for the S&P 500 to lose 4 points tomorrow. So we'll keep our eye on that possibility. If we close 4 points lower tomorrow or more, which would be the likelihood, right? The chances of us only closing lower by 4 points would be fairly rare. So let's just say that it's more than 4 points. Then tomorrow, David might very well be back with you at this video tomorrow afternoon/evening saying that we are at 6-month lows, right? And then we'd be talking about going back a full year, right? And at that point, we would be pushing ourselves all the way back here probably to July of 2021. And then the next level is June. And then we've got May. And those numbers are not all that far away. So you can see how this type of thing can really spiral out of control in a hurry. They always say that markets take the stairs up, right? They grind their way higher, and then they take the elevator down. And it happens much more violently and quickly on the downside than the gains are achieved on the upside. And that's what we have to be a little bit worried about right now, especially since this is a headline-driven market where those headlines are coming from parts of the world, Russia/Ukraine, that we really have no control over as U.S. investors. And so makes it a little bit more concerning right now as well. So anyway, back to the 3-month chart here. Just to put a ribbon on it, S&P 500, as mentioned before, was down 1.01% today. Dow Jones was actually one of the day's worst performers, down 1.42% today, and that was a direct result of Home Depot, as I mentioned before. Home Depot down 9% on their earnings announcement today, and since there's only 30 stocks in the Dow Jones Industrial Average, with Home Depot being one of them, it has a bigger influence on that blue chip index. The NASDAQ was only down 1.23% today, so a relative winner compared to the Dow as being a rare event. Remember, it has normally been the opposite of that so far in calendar year 22. And then the Russell 2000 was actually today's worst performer. down 1.45%. But again, got to give Russell 2000 a little bit of credit for being still well above its lows from late January, whereas the other indices don't really have that kind of breathing room at this moment. All right, let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these presentations here. And so the last time I did the video on Thursday, 103 of you stepped out of the woodwork to help support us. Remember, you can do that by clicking like here directly on our Twitter feed itself, where David and I pin our most recent market Outlook presentation to the top of our Twitter timeline. Otherwise, you can find the tweet in question as an embedded widget directly below our video if you're watching it on our website. Otherwise, you can also find the tweet in question in the description area below the YouTube video if you're watching it directly on YouTube. And you can also find it in the email notifications we send out to you. There will be a little Twitter icon at the bottoms of those emails that you can click on that'll take you directly to this. So 4 different ways to make it easy for you to help support these presentations. Remember, we don't get paid to do these presentations, yet we try to do them for you 5 times a week, and they take about 3 hours of our day. So, hopefully your 5 seconds to click like for us is worth your time, considering how much time we have to put into producing these for you as well. As I always say, as long as I'm getting up and over 100 likes, I'm willing to give you the full-length version of the video the next time around, which is why I'm doing that for you right now. So if we're under 100 likes, then I'd probably just give you the 15-minute version of the video. So if you prefer the longer formats that include the trade application examples, click like for me. If you don't prefer that, if you don't want me to do trade application examples and you only want a 15-minute quick hitter video on only the indices, then don't click like. And as long as we're under 100 likes, then I'll just do an abbreviated version of that. So thank you to all of you that help support that, including Brad and Dave and Firas and Carl and Barbara and Glenn and Sarah and Money Trejo. Okay, that's cool. That's cool. Went to a Rams game a couple of years ago, and Mr. Trejo was actually sitting just 1 row away from me. I told my wife we need to go and visit his taco stand, because he's quite the businessman there in L.A. Some of you might recognize him as being a popular actor / Rams fan as well, apparently. Thank you to SW. Thank you to Michael and Claire and Riker and Michael and Ed and Kirk and Kenneth and Jayesh and Ken and Jimmy and Ray and Ken and Dale and Steven and Margie and everyone else here. I can't get to all of you, but we see you coming in, and we appreciate you guys helping us along with that. Also, the Sector Selector has been produced and is available on our website. Remember, if you're a premium member, you would access that along with the other premium tools up here in the Premium Tools mega menu, where you can access the Factor Selector, the Sector Selector, the Stock Selector, and then all of our premium resources, including tutorials on how to get signed up for our trade alerts, and how to get signed up for all of the classes and all of the the charts that we share with you guys, and all that kind of stuff is in the premium resources area. So anyway, here on the Sector Selector, you can see that it was energy that maintained the top position. Now, for those of you that have been watching these presentations for a while, that should not be a surprise to you, as I've been telling you countless times that it's really energy and everybody else, right? Sometimes you have just a little bit of separation between the various sectors, but that's not the market environment we're in right now. Energy stocks have just absolutely torn higher in calendar year 2022 and have just simply pulled away from the pack. For those of you that might be marathon runners, think of energy as the lead runner out there, and everybody else, all these other sectors, as being back in the pack. So in second place, we do have consumer staples. Financials did manage to make their way up. Remember, they probably benefited to a degree from rising interest rates. And then materials also managed to go up a little bit there. Remember, the gold miners are part of the materials area. So not only did the materials benefit from other rising commodities, but in particular, gold has really been making a move here more recently. On the downside, once again, information technology dead last at the third time in the last 4 weeks. Now remember, that had not happened once in 4 years up until January 28th. Now it's happened 3 times in the last 4 weeks. So technology, not a great place to be. Remember, we do have a bearish trade going on Microsoft right now for this presentation, so it doesn't necessarily hurt my feelings from that perspective. But clearly, if we want this market to feel a little healthier moving forward, we would want to see technology leading the way, because it is the most influential sector from a market cap basis out there. Without technology, we're going to be spinning our wheels in the mud. So not a great look to have technology at the bottom and something like consumer staples up there in the second place position. Now, I'd mentioned this a little bit earlier, but just to put an official ribbon on it, some of you might have received an email from us earlier today. Otherwise, you might have seen our tweets or what have you. Let me just get the email out here. We're having a little bit of fun with today being such an interesting date from a numerical perspective. This is the only time we can say it's 22222. And as David was joking earlier, this is literally a one-time sale here, unless David and I somehow magically lived to the year 2122, which I'm not anticipating. So in honor of this day, we are throwing our biggest discount ever. Just because the numbers worked out, we figured we'd throw it for 22% off. Remember, normally we don't go beyond 20% off, and we usually only offer our 20% discount one time per year during Black Friday. This past Black Friday happened to be a time when the stock market was still reasonably strong. We've had a lot of people emailing us and tweeting to us and different things like that in recent weeks and months, now that the stock market has fallen off of a cliff, wondering, hey, are you guys going to be doing another discount? Are you going to have another sale coming up? I missed it during the Black Friday event when I thought things were rosy and I felt comfortable with my own abilities to manage my portfolio. Now I can see the other side of the coin. When the markets are falling precipitously, some folks aren't feeling quite as comfortable managing their portfolios as perhaps they felt last year. And so naturally, with a few more nerves in the marketplace, you might feel the benefit of having an educational program that kind of moves beyond just a couple of strategies here and there. Remember, we teach 10 different weekly classes to our premium members. 2 of those classes are question and answer sessions where you guys get an opportunity to work directly with David and I asking us questions. And then the other 8 classes are trading rooms where we're teaching specific strategies and techniques and managing paper money portfolios based upon those theories. So we're actually showing you in real time the trades that we are making. And so that goes much more extensively beyond what we show you here in these free videos on YouTube, as you can imagine. So for the next 2 days only, so this will expire on Thursday at midnight, you have the ability to take 22% off on our 3-year premium subscription. And you can see the details in the email down below. Hopefully you received that. If not, we could certainly forward it over to you if you weren't part of our group that we sent that out to with our distribution list. But in order to take advantage of this deal, here's the important part. Use coupon code 22OFF. So that's all one word there, 22OFF, and that'll get you that 22% off. That'll save you $653. So in the end, you should pay about $2,300 for 3 full years. If you were to break that out over 36 months, it's effectively like $64 a month, right? You'd have to pay that all up front, but if you wanted to think about how much that would be on a per month basis, it's approximately $64 per month, which is way cheaper than the $99 per month that we charge our Plus subscribers. Now, our Plus subscribers only get access to our 8 trading rooms with a few other basic things. You, if you do this deal right now for the full 3 years, get access to everything we offer. And that includes, it looks like there's a hyperlink here as well. That'll take me to the website so I can show you all the wonderful things you get as a premium member. Remember, over 90% of our members are premium members that get access to this, but we're talking about all the basic and plus products, so everything you see over here and over here, the 50 custom Thinkorswim chart scripts that you see David and I using during our presentations, 2 additional weekly question and answer sessions, so that way you can ask David and I direct questions about your trade setups and in our opinions on those. Real-time trade alerts. Remember, many of you might have followed us when we were with Invest Tools by TD Ameritrade. Over there, we couldn't give you real-time trade alerts. You had to be in class to, experience the benefit of getting the knowledge of those trades that we were taking. Now that we're kind of doing things on our own here at Market Scholars, we work with the Telegram app that is available on your smartphone or on the desktop computer, where you guys, even if you're not in class with us, will learn what our trades are when we are making those trades. And that includes these trades that we do here for the Market Outlook videos as well. You'll also get access to the class forums and groups. You get access to David's breakdown of his options classes. You get access to my sample trading plans for my trading rooms. You get access to the sector selector, the stock selector, the factor selector, the dividend tracker spreadsheet, the position size calculator, other premium forum areas, including the TOS or Thinkorswim platform forum, and then priority support there as well. So tons of great stuff here you would get access to with today's sale. And you can see there's a red banner up at the top of our website right now over at marketscholars.com, and it also mentions that 22222 sale. And if you click this button right here, it'll take you to that area. But again, the key is using 22 off is the coupon code. So when I click on that yellow button right there, it takes me to that area where you would sign up. And just to make sure you're all aware of where you'd put that coupon code in, because it can be kind of tricky to spot. As you scroll a little bit lower, there's this area directly below where it's asking for name and stuff like that that says have a coupon there in the orange font that I'm kind of circling right now. If I click that and then type in 22 off and then hit enter, it'll kind of generate that, and you can see it just changed it right before our eyes up there where that 22% off is then applied. So anyway, make sure you're going through that process the right way. But thought we would share that with you. Again, that's available for 2 days only, the 22222 sale for 22% off. A little bit of fun with numbers there. All right, back on track. Forgive me for getting excited about that. Remember, we do these YouTube videos for free. We don't make you guys listen to advertising or anything along those lines. So you have to forgive us every so often when we have an actual sale where we try to make money and provide for our families as well. We can't do all of this education as a pure charity to folks, and I think most of you understand that. So by those of you that eventually sign up for our premium services, you're effectively subsidizing all this free stuff that we do for you along the way. All right, let's go ahead and get back on track with some more charts, and let's do some 12 grid analysis. Starting with chart 5A, and this is our asset class 12 grid. A reminder that the background colors of these charts will tell us whether we have a bullish or bearish posture using the intermediate line on the market forecast. So right now, we only have 3 charts that have green background colors on chart 5A. We have gold down below, which, by the way, we have a position that's long gold in one of my classes right now. In that email, I didn't get a chance to get into all the details, but we kind of talk about in that email how people have inquired, how do we handle market pullbacks and skirmishes? Well, there's a variety of ways to do it. David has short futures in some of his classes to hedge portfolios. I have long commodities in some of my portfolios. We do bearish options trades and then also short selling ideas in our various classes. So there are a number of ways that we can manage through these more difficult market periods other than just being long stock, right? A lot of people know how to do that. And when times are good, that can be a perfectly acceptable way to manage portfolios. But when times are bad, as they are right now, sometimes you need to have additional tools in your toolbox, and that's where Market Scholars Premium program can help those of you in need for that type of education. Anyway, gold is doing quite well right now. It's I've been breaking out here. I've been mentioning that in the last few presentations I've been giving to you. Remember earlier, about a month or two ago, it was more in a holding pattern sideways. And I was saying this would have been a good candidate for an iron condor because it was basically going nowhere. It wasn't breaking out to the upside. It wasn't breaking down to the downside. We were patiently waiting for a breakout or a breakdown. Well, we've had it. We've had the breakout to the upside for gold, which oftentimes is viewed as a safe haven type of an asset when there are geopolitical concerns as there are right now. So gold was up just a touch here again today. It was up 0.21%, and you can see we have made it a long ways off of that rising 30-day moving average there as well. So strongly bullish posture continues on gold. Oil was actually up today as well, over 1%. In fact, I heard on CNBC earlier today that Brent crude prices are getting close to 100. I think they went to 99.5. Brent crude is used a little bit more over in Europe. We use WTI a little bit more here in the United States. But anyway, oil prices continue to go higher, and that's not a surprise based upon what we've learned with Russia-Ukraine. What's a little bit more surprising is what I mentioned before. Energy stocks were down today, and this is also somewhat surprising. Notice the background color of oil's chart is now light pink, telling us that we have a weekly bearish posture on oil. Now, I'm going to say the same thing here that I said to you guys a couple of weeks ago based on the overall markets themselves. While this is a weekly bearish posture here, I'm not going to actually trust the posture until we start breaking down below the moving average. I want to use both of those in unison. So I still tend to think of oil as being bullish at this moment in time, but it probably is fair to say that it's gone up a little bit too far too fast. And it wouldn't be surprising at all if oil just kind of, drifted sideways for a bit to kind of burn off some of that fat. I mean, this has been a massive move off of the lows here. You can see that in the last 3 months, oil is up 20%. That's what that kind of 20 in the black tag right there is telling us, that in the last 3 months, oil is up 20%. If I were to change that to a year to date instead, you can see that just since January 1st, it's up 19.5%. Remember, we have seen a lot of asset classes suffering so far in 2022. Oil is not one of them. It's actually basically in its own bull market at this moment in time. So be aware that the posture did shift to weekly bearish, but that could flip back to strongly bullish within just a heartbeat, the snap of the fingers. It likely went to weekly bearish because this is a pretty ugly candle here where we gapped up and we closed near the low of the session and kind of filled that in. So it's just accounting for that kind of ugly candle and price action we saw today. U.S. Treasury yields remain with a strongly bullish posture. You can see here we have had a pullback in yields in the last week and a rise in TLT over the last week as well. Some of you know that one of my put spreads, my short put spreads, was expiring on a Friday, and I was thinking, man, how close can you possibly get to being so close to winning, yet you just had a loss, and that was the case with TLT. Remember, we needed it to close above 139, and we couldn't quite get there. It's at 138 right now. So if I would have just been one strike away, instead of doing the 139s, if I had sold the 138s instead, I would have had a winning trade there. So sometimes you just lose by the slimmest of margins, and that did happen in the case with TLT. But the truth of the matter is this is still an ugly looking chart with TLT. You've had your reversion to the mean off of this most recent oversold cluster, but you're still below that falling moving average. So again, even though the background color is light green here, suggesting a weekly bullish posture, I would still be a little bit paranoid here, getting too aggressively bullish on TLT. If you can have a more flexible trade like I did with selling a put spread, where it gives you that opportunity to be slightly wrong because you're selling out of the money strikes, that's one thing. But to be aggressively bullish here, I think is just too bold for my taste if you needed a big directional move higher. Right now, I still see TLT as being in a downtrend. I still see TNX as being in an uptrend. Until those moving averages are broken, I think that's where my mind is at. So anyway, we are still in a rising interest rate environment, and the market is still concerned about future rate increases. And remember, some folks have said, well, maybe the market will be a little bit more dovish around the idea of rate increases with the stock market falling and with all these concerns around Russia, Ukraine. But right now, I'm not sure that I'm seeing that, right? If that were the case, TNX would probably be below its moving average. And right now, TNX was actually up a little bit today. We closed at 1.94% on the 10-year Treasury yield today. So just a hair below 2% there. But obviously still a rising interest rate environment is what we are witnessing here. The dollar was up a little bit today, but let's call it flat. It's trading above a rising 30-day moving average with a strongly bearish intermediate posture. That's a little bit of a peculiar combination that we see right there, but let's just call that more of a flat chart on the US dollar right now. Bitcoin is breaking down a little bit more substantially. Now, this was an open candle, so it could have been worse. We did get down, down there in like the $36,000 range. We closed closer to 38,000. So it was still a bad day for Bitcoin as a risk asset, but it did rally back towards the end of the day. So I suppose there's that. It's still trading above its lows from late January. And again, remember, that's not the case with the S&P 500. The S&P 500 today is at its lowest close of 2022. That is not the case with Bitcoin. So at least there's that little bit of relative strength from that perspective within Bitcoin. But without a doubt, that chart still does not look very attractive, right? It looked more encouraging to me when it was up here above the moving average, but it has proven in the last 2 or 3 sessions that it couldn't maintain those levels. So now you have to kind of shift towards more of a bearish stance again on Bitcoin. On most of these other charts, not a whole lot to report other than sell-off after sell-off after sell-off, right? Whether it's foreign developed stocks, foreign emerging market stocks, preferred stocks, foreign bonds, or high-yield bonds, they were all down today, and they all have bearish postures to one degree or another, and they all have falling 30-day moving averages, which they are all trading below, even EEM. Remember, last week EEM was above its moving average, but even it has fallen back below its falling 30-day moving average. So bearishness, bearishness, bearishness. As I mentioned earlier, the charts look ugly right now. All right, let's go ahead and take a look here at our next 12 grid. This will be our US sectors 12 grid. So as you can see, we actually have only one remaining chart that has just a tinge of green to it, and that is the consumer staples. Remember, that's somewhat rare because for many weeks, energy had been the stalwart. Now, energy is still the only sector that is trading above its rising 30-day moving average. But because today's candle was so ugly, where we gapped up to start the day, so, Exxon and Chevron and EOG and Devon and all those companies were off to the races today because the narrative of the market was, hey, oil prices are spiking based on Russia, Ukraine. But as the day unwound, we saw most of those stocks selling off, and we closed near the lows of the session here. So that is an ugly looking candle there on XLE, right? That's the biggest red candle on this chart going back 3 months. And it's a bearish engulfing candle that's engulfing several days worth of price activity. So that needs to be accounted for when the intermediate line is kind of taking its roll call and spitting out its readings. So right now it's at 78 and falling. Remember, if it were above 80, we'd be forgiving around that point. We'd still call it bullish. But now that it's fallen below 80, we now have to shift to weekly bearish there. Now, I'm still holding out some hope that it can maintain some strength right around its moving average. It tested it today successfully, right? You have a little bit of a long lower shadow there. It's hard to see because the moving average itself is kind of in the way, but there is a shadow underneath today's candle telling us that we tested that rising moving average and XLE did not want to close below it. It did manage closing above it. So I think that's the positive here, but that was a really ugly looking candle. So, you know, it wouldn't be outside the realm of possibility for things to get a little bit more bearish there for those energy stocks. Again, notice they are up 20% over the last 3 months. Kind of ironic that oil prices themselves are up exactly 20% over the last 3 months, and oil stocks as a collective group are also up exactly 20% over the last 3 months, which is by far and away the leader of all of these, right? If you look at these labels to the right of all these charts, there's nothing even remotely close to up 20%. The closest next competitor would be consumer staples, and they're only up 4% over the last 3 months. So that just goes to show you how much of a lead energy has, going back to that comment I made before about the marathoner. Energy, you know, is way out front of the pack right now. So they have a lot to give back potentially as well. Staples are positive over the last 3 months, right? Your Procter and your Procter Gamble's, your Pepsi's, your Coca-Cola's, you know, those types of basic companies. You know, we have that sold put trade on Clorox as an example. Those types of companies are more stalwart companies recently. Clorox was a unique example where we did our bullish trade after they got murdered on their earnings announcement, but they've held up really well. In fact, they're up nicely since that terrible day. But the other consumer staples have held up much better along the way on the whole, right? This XLP will tell you what consumer staples are doing collectively, even if, you know, some of them might be ripping higher dramatically, some of them might be ripping lower dramatically. But in general, the collective group of consumer staples is positive over the last 3 months. And other than energy, that's the only sector we can make that claim for. So is it all roses with consumer staples? It's not. I think they are a place that's perceived to be a place where you can kind of hunker down when the market is fearful, and they're getting that benefit right now. But even having said that, notice that they are trading underneath their falling 30-day moving average, which is why that 30-day moving average is red in this particular case. So while the posture is bullish or weakly bullish, the path of least resistance still has some question marks behind it. Because it's so close to that moving average, right, it could bounce right above it tomorrow. So we don't want to make too much of it. But just be aware, it's not all roses here with consumer staples either. These charts are ugly across the board. Take a look at all of these and ask yourself a basic question. Does this look like a healthy market? Of course not. These things are rolling over in a major way right now. And if you're a short-term trader, you've got to trade what you see, not what you feel or think, right? And right now what we see is a lot of ugly charts out there. In terms of who our worst performers were today, the worst was consumer discretionary. Now this is XLY, which is the market cap weighted version of it. And remember what I've shared with you guys for many months at this point, which is XLY is effectively controlled by 3 stocks: Amazon, Tesla, and Home Depot. And with today being the day where Home Depot got smashed, it's no surprise that discretionary as a whole really struggled here as well. If you were to look at the broader based consumer discretionary, so take a look here, that XLY is down 2.92% today, so nearly 3%. If we look at RCD, oh, I take that back. It was also down 3% here today. So I was thinking that XLY would have been much worse, but it does kind of go to show that that did bleed over to other retailing types of securities out there as well. So I guess you couldn't hide in too many places at all, whether it was market cap or equal weighted. Discretionary got blitzed here today, nearly 3%. All right, now speaking of Home Depot, let's talk about our trade application example. You guys heard me mention this to you, last week at some point. I don't remember if it was the Tuesday or the Thursday version that I did. But, oops, hang on. Didn't mean to go that one. I meant to go to 2A. There we go. So let's go over here to 2A. And this is our dividend stair-step chart. So this is the chart that we use for my long-term classes. So I use it for my Tuesday dividend growth investing class, and then also my Monday afternoon options for long-term investors class. And I'm going to pull up Home Depot here because Home Depot got smashed today. And one of the comments that I made last week is I am in this mindset that when the markets rally, I want to do bearish things. So, for instance, last week, that's why I did that Microsoft bearish trade. And, a week or two prior to that, I was doing the Danaher trade and so on and so forth. And then when the markets get hit, if they get hit particularly hard, 1% or more, then those are days where I also want to fade that move by doing a bullish trade, but there's a difference in the selection of the trades that I'm doing. With the bearish trades, I'm a bit more aggressive. With the bullish trades, I'm not aggressive because I still believe we are in a market that you've got to be careful in because we are mostly heading lower. And so when I want to do a trade that is less aggressive but still bullish on a day when the stock market's getting hammered, I do what's known as selling puts. And a put sale is effectively a way to generate income by taking in a credit to start your trade, and it gives you plenty of flexibility to be wrong. So with Home Depot, earlier today, after seeing it down 9 or 10%, I sold an April $250 put on it. So if I were to come over here to the trade tab, you can see that I sold that put at about 4 minutes before noon my time out here in the Mountain West. So about 2 p.m. Eastern time. And I did that trade a little bit earlier than I normally would. A lot of times I do the trades for these videos maybe about 15 to 30 minutes before the close of the market. But Home Depot was getting hammered at that time. It was down here closer to 314. Let's see where it would have been. It would have been about right here on the chart. So it would have been at about $313 at that time. It eventually went down to $312 within about a half an hour after me getting that executed. And remember, I sent out the telegram to all of our premium members right after I did the trade. So that gives them the opportunity to think about whether they want to also take the trade or not. Obviously, we can't recommend that, but it's up to each one of you as individuals to determine whether that's a good trade for your personal situation or not. So in other words, anybody who would have wanted to get the trade done at the fill price that I got at $2.50 would have been able to accomplish that. In fact, some of you might have been able to get a slightly better fill price because Home Depot did fall a little bit more after I placed that trade. And then it eventually started rallying into the end of the day. So I got filled when Home Depot was around $313. You can see that it closed at about $316, and therefore I'm already up $25 on the trade, or about 10% based upon the risk that I'm taking with this trade. So that's just one example. Obviously, it doesn't have to work this way, but again, some of you are watching this video for free right now, and you might not get a chance to place your trades until tomorrow. And what if the market's gapping up tomorrow? Not only are you going to be behind the curve from what we got in 2 hours before the market closed today, but your pricing that you get filled at is going to be even that much worse. Again, $25 isn't going to be a make or break situation for you, but it does highlight why, going back to our sale that we're throwing today for our premium members, you getting immediate access to when David and I are placing our trades, that can be valuable information for you. So let's go back on over here now to the chart and kind of explain what it is that I did. So I sold the $250 put here, which puts us down here in this blue zone. Now, part of the reason I did the put today was because they also announced a 15% dividend increase. I think I even tweeted about that earlier today. Let's go over here and see if I can find that. Yeah, right here I said Home Depot hiked its dividend 15%, which is in their own control. Their board of directors makes that decision. Home Depot's stock is down 9% currently, which is not in the company's control. Remember, that's Wall Street sentiment controlling stock price activity. Truth is, it's a fantastic business, but it's been overpriced in the past. So now it's got to give some back. I said if it gets to $250 again, grab it. And again, that's not a recommendation, but the reason I'm showing that to you is because I already highlighted to you on Twitter where I think would be an interesting price to grab it. And the reason I suggested 250 would is because of this dividend stair-step chart. And this dividend stair-step chart is showing us from a historical perspective where previous income investors have been willing to step in and buy the stock based upon what they perceive as an attractive dividend yield. If this stock were to fall down to $250, it would have a yield of over 3%. Right now, its yield is like 2% if you're not accounting for the new dividend increase amount. But if you got your calculator out here and you said, okay, 190 is the new rate that they just announced this morning, annualize that by taking it times 4 because that's a quarterly dividend. So they're going to be paying out at a new rate, $7.60 per share for dividends. You divide that by, let's call it 250, but technically we could do 247.50 because remember we took in $2.50 worth of credit, so you shave that credit off of your strike price of 250. So our break even would actually be 247.50 and our yield would be 3.07% there. That is a tremendously high yield compared to what people were looking at with Home Depot just yesterday. So if it gets down there, I'd be happy to scoop that up for a long-term perspective, as that has been viewed as an attractive place historically to be picking up Home Depot. And if it does get down there, we pick it up at 250. So that's what we're putting ourselves on the hook for, is to buy it at 250 in the middle of April if it's down there. If it doesn't get down there, then we get to keep the $250 that came into our account today as credit, right? Think of that as a payment to us for us to assume somebody else's risk. We received $250 in our account today for our willingness to buy this stock at $250 in April if it does get down there. And if it doesn't, then that $250 is ours to keep. If it does get down there, then Home Depot is a fantastic company for the long term, and I think that that is an attractive enough yield. Okay, so with that, I want to thank you for joining me here tonight. Again, take advantage of our 2-2-2-2-2 sale if you're interested in our premium services. And David, I'm sure, will be sharing that with you tomorrow as well because it's available for 2 days. And really appreciate you guys supporting us along the way. If you could do so, again, that would be great. Remember to say thank you for taking the time to do these videos. All we ask is a simple like on Twitter. If we're up and over 100 likes, be more than happy to do another full-length video for you next time around. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.